All
Wow.
right. Hello, everybody. This is Tom Randall from GoldenCare. Want to welcome you to this webinar today. I've got a lot of stuff to go over with you today, so I'm not going to spend a lot of time on the behind the scenes. Besides the fact that I will remind you, you'll get these slides, so you don't have to panic about that. And again, I won't make you look at my ugly mug staring at you for a while, but I've been around at GoldenCare. I'm the national marketing director. I've been here, I think I'm in my 28th year now. And GoldenCare just celebrated 50 years in the industry. And this whole year, we're kind of having some celebrations, and we had a formal one. It was really nice because Lenny Anderson, who founded GoldenCare, many of you on this call maybe know Lenny and his family, how they built GoldenCare up. And it's kind of funny what you do between the dashes because in that 50 years, we've really prided ourselves on being leaders in this industry and trying to help you folks go out and help so many people in this extended care or long-term care, short-term care market. So today we're going to talk a little bit about the big picture, and these are always fun when I give these WOW webinars because there's so many different topics I can get into, and you guys all know me now that I get into this and you're kind of drinking out of a fire hose. So some of you have seen this little guy before on my previous webinars. I just Google him. He's not related, but he's kind of drinking out of a fire hose. This is the best gift I could find because he's a kind of good looking kid. But sometimes you feel like that when you're going through my webinars because there's so much to talk about in this industry, and I'm very passionate about it, as you know. So today I'm kind of going back to the why are we in the market and why is short-term care and this extended care market growing so much? And I'm going to get in some new data that's been out there, so hopefully that'll interest some of you. But hopefully at the end of this webinar, I'm going to not put you to sleep, but kind of wake you up to say this is a market that is so important. I skipped the slide, which is really rare for me. The one that a lot of you maybe are familiar with, that one that I always start out saying, why are we doing this right here? 70% of adults Americans, once you hit age 65, will need some type of extended care, and 90% of people have never had a conversation about it, a true conversation with a professional. So it's really important. With the baby boomers growing up, we have so many people who need these products. And I've really loved my job for 28 years here because I was back in the trenches. We were out with our friends at AIM over $1 billion of long-term care, and I used to go out and do live seminars. I always say webinars, live seminars all the time. We'd see these seniors, and we'd be out there doing such a good job of really explaining what we needed to do. And back in the day, we could go out and help a lot of the people in that room. But now what's happened is we all know, and you've seen this slide before if you've been on some of my webinars, because we kind of give a method to our madness that if you've been in long-term care or you know about long-term care, you know that today we've got so many meds out there and people are pre-diabetic who the underwriters know that just basically means you're diabetic. So right now what we've seen is if we gave live webinars or seminars today, we'd end up having so much adverse selection. So many people are out there saying, well, boy, this really sounds interesting. I guess I need this. But they waited a little bit too long. So a lot of them are in there in wheelchairs or with health conditions. We just can't help people. So you can see that chart in the lower right, and I'll show you updated data because that was right from Milliman back in 2021. So we know that this market has to shift. We have to do it. You can't go out anymore, and we've had whole companies go out of business because they tried to stick with long-term care only. We know that we have to go out and not throw long-term care to the side. Long-term care is still a super important product. We love long-term care. For a lot of people who can afford it and who are healthy enough to get it, it might be a great option, okay? But what I want to talk about today is some of the real numbers. And again, I won't hopefully bore you to death with the stats, but these stats are real, right? This is from Milliman's latest study, and you can see there in 2023, for a 70 to 74-year-old that you're in front of in long-term care, you're going to have 46.2% get declined just because their health isn't good enough, right? And if you look at a 75 plus, 18.5%, why is that? It's lower because most agents are at the point where they're saying, man, once you get over 74, I don't even know if I'm going to throw it against the wall and try, because most of the time we're not going to be able to get policies. So there's a lot of field underwriting going on. But even if you look at our wheelhouse, 65, 60, look at those declines. You know what? Those are pretty high, aren't they? And we can see that that's one of the reasons a lot of the agents got a little bit anxious. A lot of agents, quite frankly, decided not to go out and sell long-term care. what I want to do for you is I have tools available for you, and we do at GoldenCare here called our pivot presentation stuff that we can say, as long as you do it smart, you can go out and meet anybody and see if they can get long-term care. And if they can't, then you can easily pivot into some of these other products. But the point I want to make today is a lot of agents stop right here and say, yeah, declines are about 50% for 70 to 74-year-olds. The part I want you to see is look at the actual placement rates. These are right from the top 9 long-term care carriers in the industry right now. And when you look at this, you look at a 70, 74-year-old, sure, the decline might be 46.2%, but look at that placement rate. The actual placement rate is 64.7% were not placed because of either underwriting, or they walked away, they got tired of waiting through the underwriting process, or they finally just got to the point where they said, you know what, I didn't think I'd get this policy after all, so I'm not going to take it. It's a little bit too expensive. So when you really look at that, there's lots of reasons, but look at those placement rates and look at the not placed. That's the part I want you to focus on. It's the reason these short-term care and extended care products are so important, because there's a lot of people out there. Think about it when you're out doing a great job of convincing somebody to protect their family. If you're out there and you have too many quivers or too many arrows in your quiver that are just long-term care, when you try to go in there, you might talk somebody into it. But then when they do get through underwriting, like I said, a lot of times they say, woo, I didn't really actually think I'd get through. I just didn't want to say no to that nice gentleman or lady. So now I end up later on dropping my policy in that first year. So remember, these are just placements in the first time at the time of the app, and once it gets issued, whether they actually accept it. So those are scary numbers, especially when you consider that most agents nowadays, not all, but most agents who are selling the bulk of the business in long-term care are pretty seasoned agents who are kind of really rolled up the sleeves to be good at it. So what we see now is there's a ton of field underwriting, right? That's why those decline rates for 75-plus-year-olds is so low, because these agents are getting smarter. They're saying, I'm going to field underwrite. If I'm going to put it in place and throw it against the wall at long-term care carriers, I want to have a pretty good idea that I have a chance to get it through. So when you put that in place, that really makes it a little scary to realize that the actual place policies are smaller. Plus, when you look at this slide, the underwriting time, right? This is no news to you. Most of you on this call, if you've ever sold long-term care or heard about it, 60 days or more for 21.8%. The average is 47 days in underwriting. So you can see there that there's a lot of delay, and that's why some of those clients, by the way, drop these policies, even in the underwriting situation, right? Once it gets over a month, then they get a couple months, and now they're hearing from underwriters that they need special forms filled to get APSs. All of that contributes to the fact that there is a long underwriting time with traditional long-term care insurance, as opposed to short-term care, where guess what? We can get these things turned around pretty quickly in just 2 or 3 days. Basically, in a nutshell, what I'm trying to say is, because of these new products, we can make this pie chart that we had half of it red before, where now we can really do a better job of helping more people. That's what's important, right? So this slide, again, is going to be, you're going to get all these slides. I put this on here more so you could see it later on, because I don't want to spend a lot of time on it. But I do want you to know, if you're new to these extended care or short-term care plans, they're incredibly powerful. I'm really passionate about it. We put a lot of our emphasis now here at GoldenCare on these extended care plans, because the new short-term care plans that have come out are incredibly strong. They're 2-year plans, but they can pack a huge punch, as I'll show you. And remember, the biggest problem with rate instability with long-term care plans was because of these longer unlimited plans with 5% compounding, and they ended up having just a few, not a few, but a lot, but really big catastrophic claims. And that's the part that caused the problems, not the shorter claims that are pretty easy actuarially to make work for the carrier, right? So at the end of the day, there's lots of reasons. No special certifications, and the underwriting time is tremendously small, and we throw the net so much wider. That's the reason that I segue into this slide. I love the graphics here. Lynn did a great job, because this to me really shows that short-term care, especially short-term care, full short-term care plans, there's some great home health care only plans, and we have life hybrid plans and some great things out there. But I'll tell you what, the short-term care plans nowadays that we're selling, like Omniflex for Manhattan Life, that's our premier product. I'm not going to hide it. That product is very, very strong, and it really belongs at the big boys table, where it can be one of those that even in some cases, somebody's healthy enough to get long-term care traditional coverage or a life hybrid, for example. And in some of those cases, we're seeing agents who are starting to realize, you know what, for some of my clients, these short-term care plans, even though they can get through underwriting, are a better deal. That's why I'm passionate about it, and I want to make sure you don't forget that. It's so hard to get traditional long-term care agents to turn their heads and start accepting short-term care. And this is one of the things that I've seen. Once you go out and write a couple of these, you're going to fall in love with them because you're going to see that they're so strong for the clients and for yourself. Okay. So that being said, we have a great selection of short-term care products, and this is moving. This is one of the reasons I show all these. We have a webinar that compares them all. I'm not going to go there today, but I do want you to know this is an ever-growing list. Just like long-term care was back in the day when long-term care was booming and now it's shrinking, right now short-term care products is really in a growth phase. We're seeing people, because more and more agents like yourselves are starting to accept them, and we're seeing more and more products come out, and people, you know, these aren't dumb. This is good old commercialism or capitalism. There we go. Good old capitalism at its best. These carriers are fighting for business. They're trying to say, I want my product to be more attractive. I'm going to work with specialists to try to make my product work well. So you're seeing upgrades in products, and you're seeing some good things. Can't go deep into it today. I know Aetna's in the process of trying to get some great upgrades to their product, and their recovery care product was really strong to start with, so it should be interesting to see. Again, I'm going to throw a shout out for that Manhattan Life Omniflex plan. If you're not with us already, check it out. It's a really strong new entry, basically a year and a half old, that's been knocking it out of the park. All across the board with short-term care, I can't stress enough, if you're not selling it, you're missing the boat. I'm at that point now where I'm not saying you should check this out. I'm saying you have to check it out. These are products that are so strong for so many of your clients. You will help yourself and help your clients if you start embracing short-term care as an agent. Okay? Hopefully I'm preaching to the choir on the call like this, but I want to make sure I really stress that with all bias and prejudice, right? So if you look down here, there's a lot of states that don't have yet. You'll get this slide later on. I'm not going to spend a lot of time on it. There are some states that just won't go there. But remember, this is our short-term care, full comprehensive facility and home health care plans. We offer a full selection of home health care only. These little near guaranteed issue life and hybrid plans are really having a lot of spark in the industry. Be on the lookout. We've got some great ones there with Mass Mutual and with the Chubb products. So we've got some really nice, practically guaranteed issue life hybrid plans that are really strong as well. So those are also in a lot of states. But the big thing I want you to know is when I throw that pie chart out there, I can feel like it's very realistic because the underwriting is so mellow for a lot of these products, like home health care only plans. Remember, what's the underwriting? Hey, by the way, are you in a facility right now, or are you receiving home care right now? Oh, you're not? Guess what? I can get you a home health care only insurance plan, okay? And again, they're not available in all 50 states, but True Freedom is a prepaid home care plan that is really strong. Check it out on our website. Check it out if you don't have it. It's a super easy plan. You don't have to have special licenses or anything because it's not even a true insurance product. But it is a great, great protection plan for your clients. And the nice thing, again, it's available in all 50 states. So no matter what, if you have some state where there's not a lot of other things available, you know True Freedom's going to be there for you. Okay? So let's go back to Milliman real quick. Consumers not only hate the waiting for the underwriting, but what they hate a lot, and if you've been in the field for long-term care or you've heard stories, you know this is true, they actually hate the wait at claim time, don't they? It's kind of part of the picture of long-term care. When you look at it, for age 84 to 100, these are elimination periods now for facilities, 91%. And then there's a lot of home health care 0 days out there, but you can see that because of the cost nowadays, the first day home care is a little bit lower than it should be as well. And that's mainly because of the cost bearing. You can see in previous years, a lot more people sold first day home care. The reason is not because people don't want it. The reason is it got expensive. But check that top one out again when you go back to facilities. If you take 84 to 100 and then 100 to 200 or over 200 elimination days, 97% plus of those policies are sold at 84 plus days of elimination. You don't think that matters? Tell you what, at claim time, this is 10 years down the line a lot of times. People buy a policy, they're waiting for it, and they say, oh, good, mom went into a facility, she needed some help. and all of a sudden they realize and go, well, wait a minute, I have to pay that first 90 days. 90 days is by far the most common. You start doing the math on that, remember, $6,000 a month if you would have had that coverage available, and you have to pay that, wait that 90 days, guess what? You're looking at $18,000 out of pocket that you're paying before the policy kicks in, right? So you guys all know that, but I'm bringing that back to one of the biggest strengths of these short-term care plans is right here. Remember, with elimination periods, the way we have these policies set up, some agents are gravitating towards old habits and they're writing 90-day waits on facilities, which are available for some of these plans. But what I'll tell you is, roll them up. Look at the price difference. I helped design some of these policies. I know our team put together rates that say it's not that expensive to go from 90 days to 60 to 0 days. Look at the 0-day first day coverage with these short-term care plans, and I promise you, you'll be pleasantly surprised, and more importantly, your clients will be surprised because it's going to be a lifesaver at the time of claim, okay? Because remember, not only do we sell first day coverage with no elimination periods a lot of times with these plans, but we also have no 90-day certification requirement at claim time. Remember, long-term care insurance, do you need help with 2 of 6 ADLs, activities of daily living, and will you need it for at least 90 days? With these plans, there's no 90-day certification. It's just the 2 of 6 or cognitive impairment. So long-term care, of course, has cognitive impairment as well. But the 90 days is the key. Now we can have people who can be major league denial saying, I don't see myself going to a nursing home. I don't see myself having a major stroke and being laid up for 2 years. I don't see myself having these major custodial care type long-term chronic conditions. But with short-term care, we're going to cover those. But what we'll also cover is some of these things that almost everybody you're sitting in front of can see themselves doing. I can see myself needing a hip replacement or a knee replacement or having a cardiac problem or a surgery that's going to lay me up just for 10 or 15 days. I can see myself having an accident someday that maybe I'm going to be laid up. Maybe not for 90 days like a long-term care plan, but I might see myself laid up for a couple months. That's the important part of this, because with short-term care, especially with first day coverage, these plans are super valuable for these littler claims that people can see themselves having. And then these plans have restoration of benefits, right? After 180 days, when they're feeling better after that minor incident, this plan will spit those days right back into their policies so that they're going to have the ability to say, hey, guess what? Now I have that full amount of days available again in case I have that bigger claim that can be life-changing for me and my family. That's the beauty of this. Remember, we say you can have your cake and eat it too, and that's what I mean by that. You can have multiple smaller claims with these short-term care plans, and like Omniflex, for example, has multiple restorations. That's why we say, listen to GoldenCare, let us help you find policies that have the strongest areas, and that's another reason Omniflex is one of our leaders. It has multiple restorations, so does Aetna, for example, multiple restorations on both the facility and the home care side. So that is really big, and if you look at long-term care, this is Milliman again, restoration of benefits doesn't happen as often with long-term care plans. That's why I spent a lot of time on that with some of you agents who might be in the long-term care trenches in the days. Restoration was, now it's an added benefit that you have to add on to your long-term care plans. With short-term care, it's built in. And with long-term care, 17.2% of the plans have restoration. And the reason for that is, with that 90-day certification, most of the time with long-term care, I'm not saying it never happens, restoration is strong in long-term care, but with 90-day certification to get on claim, a lot of those folks are in for the long haul, right? They're not going to have the ability or the need to restore their policies. With short-term care, because of that no 90-day certification, huge difference, okay? And again, I know that I'm soapboxing a little bit here, but again, it's so important for me to tell you guys as you're out talking to those seniors and talking to younger folks as well, these are definite important things that make a difference at claim time, and it makes it much easier for you to sell the policies and help people as well. So I want to make sure you're well aware of it and you educate your clients about it, okay? Now you do get these slides, so I'm going to go through this really fast. This is going to be drinking out of a fire hose in a big way. Basically, I want to make sure you understand how Medicare is out there. Medicare is getting stretched thin, right? We know there's a lot of gray hair in America. We can get into politics, but we won't. But whatever side of the aisle you're on, we know that Medicare coverage is tight, and we know that the government's saying, "Ooh, we're spending a lot of money on Medicare." So you remember, if you look at Medicare, I gave a full filling the gaps webinar on this. So when I say remember Medicare Part B, that's the medical coverage part of Medicare. So basically what happens is hospitals can get in trouble, and they get in trouble if they do readmissions. So if they put somebody in as a patient when they shouldn't have been a patient, and they pay auditors at Medicare level to go out there and check this out, what happens is these hospitals will say, Medicare will say, we're not paying you for this care. So hospitals have really started using this observation status, so they still can get paid on Medicare Part B, but they can avoid those inpatient audits and penalties. So we've seen this huge, and you can see on this slide, observation status increased dramatically. 2007 to 2009 alone, it went up 34%. From 2002 to 2012, it went up by 88%. So the CMS knew they didn't like this, and they knew hospitals didn't like it, so they said, we're going to come out in 2013 with the 2 midnight rule, and they thought it would help doctors with admitting decisions. And basically it says, inpatient admission and payment are appropriate when the treating physician expects the patient to require a stay that crosses 2 midnights, and they can admit the patient based on that expectation. Well, unfortunately, what happened is they were still having these no reimbursement penalties and having problems with readmissions. So they realized they're getting paid either way at Medicare Part B and with the patient chipping in. So they still stuck to their guns and had a lot of different observation stays, right? And why does that make a big deal for your clients? Again, I'm going to go through this quickly. First of all, observation means that they have to pay more out of pocket because it's paid by Part B and not Part A. But more importantly, the 3-day inpatient requirement for skilled nursing follow-ups. This is right in our wheelhouse now because we're talking about long-term care and short-term care, especially in those nursing facilities, right? So you can see here the official rule, 3-day rule billing, says to qualify for skilled nursing service charges or coverage, by Medicare, patients must meet the 3-day rule. They have to be an inpatient, not observation, okay? So what we're saying is, if you go on Google and search this out, you're going to see a lot of the implications of that. Basically, I'm not going to show you the video today because I got to get through a lot of stuff, but you can see here this gal, she actually had a fracture and it ended up being observation status, so she ended up having to pay a skilled nursing bill of $28,000 plus because she had to go to therapy afterwards. And then since she wasn't an inpatient, she was just observation, she ended up having to pay out of her pocket. So now we're going to see the moon form. And again, this is more the garden hose the fire hose I was talking about. In 2015, they came out with this moon form, which is the Medicare outpatient observation notice. And basically, when you're signing forms in a hospital, this is one of those that a lot of people pass by. This happened to my mother before she passed away 3 separate times, where we ended up saying, wait a minute, and we argued it at the point and reversed one of those, okay? So make sure you know, you have to tell your clients about this. Again, you don't have to, but you're going to be a great insurance agent if you take the time. Anybody who's in the 55, 60, 65, approaching Medicare age, tell them, especially your 65 plus year olds, when you go into a hospital, watch what you're signing. Do yourself a favor, tell your family, watch what you're signing, because basically this form, and I'm going to go through this really quick again, it says, I'm an inpatient, you're not an inpatient because, and they'll put a reason on there, and this makes a difference, right? It's going to affect how much you pay for the hospital because Medicare Part B has bigger co-pays, and then it's going to affect this skilled nursing part really big time. Because you're not in for 3 days as an inpatient, if you go to a skilled nursing facility, guess what? You're going to have to pay the bill as the patient, okay? So all we tell people is, this can affect your medications and your Medicare Advantage plans. Make sure you read that. But the big thing I tell you is, remind people to be careful what they sign, and it's easier to argue it at the time of signing than it is to go back and try to change it later. And that's the advice you're going to give to your clients, and say, just be careful what you sign, because sometimes it'll shift you over to another part of Medicare. And if you're in observation, you might have some problems with your physical therapy afterwards, etc. So It's a great lead-in to tell them, by the way, and we have a sample moon form for you here at GoldenCare that you can go out and show right to your older clients and say, you know, this is the reason I'm so in love with these short-term care plans, because you don't have to worry whether you're in observation status or inpatient status when it comes to having coverage. Because look at this, remember, see this slide, you guys recognize it? No 90-day certification. So if I come out of that hospital and if they put me down as inpatient and Medicare pays, more power to me. I've got a first day short-term care plan that's going to pay me on top of that. So I'm going to have some money to put in the bank and save for a rainy day, right? Because these plans pay over and above if Medicare or any other insurance pays. If they put me down as observation status, guess what, you guys? This is where these are lifesavers. All of a sudden, that gal who had the $28,000 bill says, guess what? I had my short-term care in place. It pays first day coverage in a facility or at home. Now I can go out and end up getting coverage there, even though Medicare balked at it. That's the reason we're in love with these, okay? Let's look deep. GoldenCare has the Omniflex plan and all the other policies. Most of these plans pack a huge punch. This just happens to be a specific Omniflex example. And again, I want you to make sure you realize, I'm going to talk as I finish up today about short-term care and why the name is so tough, because a lot of people don't think about short-term care as having a lot of punch. Check this out. Facility with no inflation, $400 per day is $12,000 a month to start with. Home health care, no inflation, $9,000 a month. Omniflex does have a 5-year ramp up, but most people don't use these plans for a few years, so that's not an issue. At the time it matures, $9,000 per month in that 5th year. Facility and home care with no inflation, a strong $250,000 pool of money. And with that restoration I talked about, $500,000. If I throw inflation on there, I'm looking at $24,000 a month facility, $18,000 a month home health care when it matures, and up to $1 million for the full plan. But more importantly, $504,000 per claim. Those are huge policies. And that's the reason I showed you this right now, is going back to Milliman. Remember, the actual long-term care claims data out there right now for all these long-term care plans, it's not $1 million, is it? There are some of those claims, but those are the ones that cause such a problem in the industry. The average claim out there for long-term care insurance, even though they have that 90-day wait, that 90-day requirement, look at that, $61,000 for total claims. And then you can see some of the lower insurers had higher averages or lower averages on the right there. You'll get these slides. My point here is, even if you look at AHIP, not just the Milliman study, we have access to this for you, and you can see state to state in the year 2023, total claims paid divided by total claims, approximately 80 to 110,000, regardless of what state you look in. If you're selling to a client in a certain state, you can go and find these exact averages. And this is a big deal. Why? Because short-term care plans out there, everybody's like, well, it's not long-term care. But remember, most of the policies we sell, not only supported by the actual claims data, but most of the policies we sell are 2 or 3 year long-term care plans. We don't go out and sell those Cadillac unlimited plans anymore because the price has gotten so ridiculous and out of hand. And again, some of you have heard us back in the long-term care days talking about short and fat policies, how strong they are. When you get right down to it, if you know most claims are going to be under 144,000, for example, look at this plan. If you had a claim, would you rather receive $144,000 over the course of 1 year if you're a client, or you have a loved one who has a plan? Because that's 1 year at that $12,000 per month. Remember, that's with no inflation on there. Once that matures, you could have $12,000 a month for a full year, 144 grand. That's with no 90-day certification, so it'll cover the smaller claims too. Or would you rather have long-term care that says that'll pay $48,000 per year if I had a $4,000 a month plan, but I have to wait and have that paid over the course of 3 years to get up to my $144,000. Again, some claims they won't even cover. I'm not bashing long-term care. We've made our money off long-term care and we've built our reputation off it for years. But at the end of the day, this is what I was talking about, how some people say, even if you're healthy enough to get long-term care, sometimes short-term care is more attractive. Okay? We know Americans are concerned. This slide you've probably seen before. Look at the overwhelming response. People are afraid of even these $100,000 bills or $60,000 things. People aren't dumb. They know that, well, if I catastrophically get Alzheimer's for 10 years, I'm going to be out of luck anyway. They know that's a panic situation. Hopefully they can get a strong long-term care plan to help them. But at the end of the day, most of your clients aren't going to argue with you when you say most of the claims are smaller, but they're still ridiculously impactful to your family. 3 out of 5 personal bankruptcies today are due to medical expenses like this. And guess what? Most of these people, about 78 to 80%, have regular health insurance. So these are the type of chronic care claims that cause a lot of these problems. The average bankruptcies in America isn't because they're down $1 million, right? The average bankruptcies that we're talking about is only about an $18,000 out-of-pocket bill. Most of your people listening, truthfully, most of you listening to this call, and specifically most of the older clients you're talking to, some of them have really huge nest eggs, but a lot of them don't. So a lot of them are willing to buy a nice, affordable, nice short-term care plan that's going to be there for them and keep them out of trouble when they get to claim time. Especially when you add in this last point, remember the cash. It's one of the reasons Omniflex is so strong. It's the reason we brought Mutual of Omaha way up to the forefront with these plans, because of the fact that we had a policy that not only paid reimbursement benefits, but also paid a cash benefit for family members. So you have the Fast 50 benefit in our Omniflex. And again, hopefully some of you have seen this slide. We have Americans who wait too long. There's so many unpaid family caregivers in America. Depending on which stats you look at, it's absolutely ridiculous. It's one of the main things that most seniors in our country end up having unpaid family members or friends or church groups, because they're out there saying, I don't have any insurance. I can't afford to do this on my own. I need somebody to help me. Okay? Even if you have paid caregivers, this is the slide I want you to pay attention to. Because even if you have paid caregivers, you can see where our family members, friends, or independent pay, 28% of all the claims out there that are actually long-term care claims, you guys. Remember, you need 90-day certifications to get them. Even there, you can see family members and friends are an important part of the caregiver solution. So why not talk your clients into the fact that you say, you know what, I'm so glad you said your daughter's going to help take care of you. How about if you could say your daughter can now feel comfortable taking a few days off work and helping you out and doing some of the more comfortable things, plus having home health care to come in and say, if we need to, we can have a full home health care, home health aide or somebody else come in instead. So having the ability to pay family members, absolutely huge. Very few short-term care plans have it. We've got GTL that has a nice little one-time lump sum. Otherwise, Omniflex is the only one that pays every single day if you'd like it on the Fast 50 benefit for the full amount of claim. So finally, I'm going to finish up before I show you that we have this support to make sure we don't throw you out of that plane without a parachute. I want to make sure you know that short-term care, I waited till the end so you could see all the positives of these plans, and I wanted to make sure you realize we saw they were robust. We saw they paid first day coverage. We saw all the benefits. They pay cash. They do all of the great things that your clients will love you for. But the worst thing about these plans is the name, right? Long-term care was taken by the federal government. So these policies are called short-term care plans. There's some home health care only plans out there as well, but I'm talking specifically about short-term care now. So when you sell these plans, I want to make sure you'll realize that most adults think about short-term care as that it's something that covers a couple days after you get out of the hospital. I've been amazed by how many adults think that. If you go out there, most people who are American adults today, if you ask them, what do you think short-term care covers? They'd say 30 days out of a hospital, 60 days, I don't know. So remember, that's the reason that you'll hear our GoldenCare trainers and myself tell you, when you're talking about short-term care to your clients, we use the term extended care or longevity care. We use some of those things because we want to, number one, have the flexibility to be able to pivot between long-term care, short-term care, home health care only, life hybrids, even true freedom, right? Extended care is a more broadly sweeping term. And it doesn't put that negative connotation of, oh, short-term care, okay, well, why would I want that? I've got a pretty big nest egg. I can afford a few days out of a hospital. So that's the reason we use extended care. The reason for this slide is those last 3 bullet points. excuse me, make sure you go full circle. Once you start closing the sale or once you fill out the e-app or wherever you're at, make sure you explain to your client and remind them, even though you probably would have mentioned short-term care a couple times, make sure you tell them this. Okay, we've got that great plan in place. It's the same great product that I sold you, but I just want to make sure, because some of my clients or other agents' clients specifically, because now I really tell all my clients, if you get an email talking about short-term care or you get a notice from the carrier, make sure you don't panic. Short-term care is just the name of this broad section of products. What I sold you today is a short-term care plan, but don't let that spook you, because it is a full-blown plan. It's the same coverage we talked about that covers you up to this amount or this amount. Okay, so just the reason I remind you that is that some of my clients or some clients get spooked by that and they end up panicking thinking they bought something different. Does that make sense? And if you do this as an agent, you guys, this simple reminder, I guarantee you, I've gone over this in my head 100 times, and I've had agents who have told me from our career shop, you're right, Tom, nobody bought that. When you remind them of that and say, I just want to make sure you're careful, because when you get an email, I don't want you to be spooked by it. Okay? It's really a smart move. Also, the final note, remember, simple underwriting that we talked about today, how we can throw that net wide and cover people. I mean, I didn't go through the application today for a plan like Omniflex, but it is night and day difference, as you saw from Milliman, night and day difference. We have about a 90% with full-blown policies. We have a limited plan within Omniflex 2 that most of you know about, but if you don't, check out the training. We have a limited plan that's still $3,000 a month for a full year for both facility and home care, so it's still a strong little plan. That one is probably about 96%, 97% of the people you come across can get that plan. So it's really easy, as opposed to that 50% notch that we're hitting with long-term care in some cases. My point is, simple underwriting doesn't just mean this is a plan for seniors. The reason I say that is, when I went out there before, I was talking about the fact that this webinar, we were going to, the title slide that one of my team put together, Lynn put together so nicely, actually said senior solutions or solutions for seniors. And I changed that to say the big picture or extended care, the big picture, because of the fact I want to make sure that some of you know, don't just think this plan is only for 60, 65 or plus year olds. You know, this plan, if you look at a 50-year-old couple in Ohio, for example, if you looked at a 50-year-old couple in Ohio, I could give them a full-blown plan without inflation, but literally $400 per day facility, $12,000 a month, and a $300 per day or $9,000 per month for home care. And that'd be for a whole year with first day coverage. So a big, strong $144,000 facility, $109,000 home care, a really strong plan. And it's $67 each for a married couple. So $134 for the married couple together. That's $134 a month. That's way less than a car payment nowadays, right? And when you explain all the positives to that 50-year-old couple, and you say, you know, remember some of these conditions, I know at your age it's probably hard to imagine yourself in a wheelchair in a nursing home, but even some of these smaller conditions, I'm offering you a first day plan that covers regardless of any other insurance you have. Tell you what, if you went in for 2 days of care at $400 per day, 2 days of care would cover your whole year for one of you. 4 days, guess what? Covers both of your annual premiums for a whole year. You as agents, think about that now. If they ever have a claim that's 40 days of claim at $400 per day would pay for 10 years of both their premiums. You want to talk about leveraging your money? And remember, these plans, these are smaller claims, and then these plans will restore it so that if, God forbid, they have that huge claim later, the one that most people don't want to think about, we know what happens. And for those type of situations, you have that full-blown plan there. And remember, when I say 40 days of care, you're still in your long-term care elimination period in most cases. You wouldn't have even had coverage. It would have been out of pocket. And you can cover 10 years of premium with just a 40-day claim. So that's how strong they are. And again, I didn't put a slide together on that, but I wanted you to know as an agent, these plans are super well leveraged, and don't miss the boat and not talk to some of your 40, 50-year-olds, because whatever products you're selling otherwise, these plans can be really strong. Okay, So now I'm just going to do my shutdown here. I know I'm sitting probably at the 40-minute mark. I want to get done in 5 minutes. All I'm going to show you now is we have everything you need to succeed, okay? If the opportunity is set the stage beforehand, you can have some pre-quote potentials. We have rate sheets I'll show you. You need a pre-screen for underwriting if you're in the long-term care arena as well. That might be important, might be nice, but you don't need it. You can go through with the presentations we have. We have a pivot presentation that literally walks you through the underwriting up front and shows you how easy it is to get these plans in place and decide what product's right for your client. And again, have your rate sheets and calculators open. This slide you'll get later on. This is the biggie right here. So many agents have told me, boy, when you said that, Tom, it hit it right in front of me. So many times I started talking to somebody about these plans, then I realized that they actually wanted to buy, and I went in to try to find my login to get to the agent site, and I ended up having a weird silence or a weird delay. Have your passwords and logins ready, or be pre-logged in so you don't get caught that way. Then remember also, if you need it, we have the InstaPivot underwriting tool, and we have StratDecision ready if you need it. So the next slides, I'll leave in these rate sheets to remind you that they're there. But what I wanted to show you is we have all this stuff available. Here's a sample app for Omniflex to show the underwriting, which I'm not going to go through today after all. But we have these rate sheets that can go in. One of the biggest reasons agents don't bring these up to your clients, they don't bring up the topic of extended care because they know the first question somebody's going to say is, yeah, that sounds a little bit interesting, Tom. How much is it for me? I'm a 65-year-old. And then the agent goes, oh, I didn't run a rate for this. This is not to say you have to sell option 1, option 2, or option 3. But what this does is gives you a quick bird's eye view to say, hey, for a married couple, for a 65-year-old, $55.46 a month for this nice little $100 a day plan, $3,000 a month. That's before the $25 a month off for RX discount, which Omniflex has. If you don't know what that is, check out our training, okay? All that's here just so you can have a quick glance at the rates, okay? Same thing with our home health care only plan. What I want to show you is you can find that stuff right here. Here's our IntegrityShortTermCare.com site. It has the ability to jump over to the InstaPivot tool. What is InstaPivot? It's a great little tool that has all these different products on here, every health condition, super easy. I'm not going to go through training on it today, but I want to remind you it's there. If you want to see how easy it is to see which plans fit for different health conditions, agents absolutely love this for a quick way to see which policies are available for which health conditions, okay? You can also get to our StratDecision tool. If you're not familiar with it, you'll get in here. It does require a login because this is such a valuable tool at $500 per year about for licensing. It's free for you if you're with GoldenCare or one of our partners. And you can see here, this comparison tool, I'm not going to go through you today, but I am going to give you every chance I get a reminder. Go down right here in the lower right and click short-term care. Then it'll give you short-term care comparisons because it also has all the long-term care products in there as well, okay? Again, I can't go through training on this, but I want to show you it's out there as I finish up. We have comprehensive short-term care plans. We also have Aetna available on our GoldenCare site. You can see information about that. This is our Integrity short-term care site of some of the proprietary products. GTL's on here, Wellaby's on here, home health care only, GTL Manhattan, and our True Freedom non-insurance plan. Click on these buttons, you guys. You'll get everything you'd ever want to know and more about all these plans, plus be able to see those rate sheets, etc., to help you out in the field, okay? So I know I'm buzzing through that fast. As usual, we're making you go through and drink out of that fire hose, but I do want you to know, I hope I turned a couple heads today or at least reinforced what you already knew. You can't afford not to have these products. If you want to be successful, if you want to have a really, literally an inspired life, a purpose-driven life, I'm not kidding you. I'm passionate about this because there's so many seniors out there. That 70% number is not overblown. No matter what anybody who thinks they're smart tells you, 70% of people once they hit age 65 will need some type of extended care, maybe that shorter care. So long-term care isn't quite 70%. That might be closer to 50%. But with these short-term care plans, 70% of adults will need it. 90% of married couples will have the need for this type of product. And for pennies on the dollar, you can get them some great leverage if you go through and help them plan ahead. So that being said, I'll get off my soapbox as I'm at the 45-minute mark. I do want to let you know again, you're going to get these slides. Hopefully I'll remember to have my team, if somebody's listening on my team, send out that moon form as well. And the big thing to know is we've got the best team in the industry here. Our phone number's on those slides. You guys know our phone number. We've got a great group of people for you here. And we want to make sure you know we've got all the tools you need on our website at the GoldenCareAgent.com. And we've got the people here to help you answer questions as well. We even have a decline program if you want that'll help you out. So that being said, I'll tell you what, thank you so much for spending your valuable time to listen to me yap at you today. And this is Tom Randall from GoldenCare. I want to tell you thanks so much, and make sure you take the next step. That's up to you. Thanks, everybody.
GoldenCare is always here to serve you with new tools, new products, new ideas, and new innovations, and always the best support in the business to help you succeed. So give us a call at 800-842-7799 and check out our website at www.goldencareagent.com.